If you're anything like Simon and I, you're super curious at the moment between the relationship with an interest rate rise and property prices in the likes of your Sydneys, your Melbournes, your Brisbane and your Perth markets. Now, in this video, instead of just getting caught up on the media hype at the moment, which is all fear and doom and gloom around property because of these interest rate rises, Simon and I went and looked at the last two previous real estate cycles, in particular the relationship at the time between interest rates and the second half of the cycle and what it did for property prices in those markets. Now, what we found is absolutely insane. I was not expecting it, and it makes me sleep, or it will make me sleep a hell of a lot better tonight. So man, obviously like everybody out there, we've been starting to think about the relationship between these interest rates and property prices. What have you been watching on TV, reading in the articles we follow, and what have you been hearing from the 100 or 200 people you've spoken to so far this year?
Now, the biggest thing that I've noticed recently is definitely a shift in the narrative from the major media outlets, which is impacting people's sentiment as well. I'm finding in most of my strategy sessions and with the people that I'm talking with at the moment in real time, there's still a lot of bullish people out there that have a positive outlook on the future. A lot of these people coming with a longer term plan, but there's definitely the questions being asked as to what could potentially be coming. How are these interest rates going to actually impact the property prices around Australia? So I think people are starting to get a little bit nervy and just unsure as to what could be coming. But all of these other things aside, like, what do you find is the relationship between interest rate rises and property prices?
You know, Ray Dalio talks about this best. Interest rates are one of the key levers that we've been using globally for the last 100 years to either artificially spike a market to get the economy going again or to pull the handbrake. Now, what normally happens is interest rates come down and they hold for a period of time. We see a increase in asset prices. We see an increase in household savings. We see an increase in sentiment and the feeling that things are going to be okay over time. And then once they start to increase again, it's actually a sign that the economy is doing better. Like unemployment's lower at the moment. There's more household savings at the moment. Inflation's above its target rate at the moment. There's ridiculous amounts of infrastructure. A lot of businesses are doing well. So they start to increase interest rates as the strength of the economy gets better. But for some reason, as individuals that don't understand this stuff, we see it as a negative. Now, of course, it's a negative if interest rates were to go to 10% tomorrow, but the RBA is forecasting a minor tweak over the next few years and what they call pacing, which is just slowly increasing it until the economy softens, because we don't want to see 30% price growth in properties year on year for the next 10 years. Otherwise, one, no one's going to be able to afford it. Secondly, we're going to have the biggest bust in human history.
Now, we've never been ones to get too caught up in that emotion, in that sentiment, in that narrative. And we always like to look back at the numbers, look back into history, because it can leave some interesting clues. So going back to a similar time in the previous real estate cycle, 2000 to 2007, what was the correlation between the interest rate rise at that point in time and real estate prices?
Great question, man. So interest rates between the year 2000 and 2007 were around about 5 to 7%, so significantly higher than we're seeing at the moment. Now, why that's important is as we get closer to the top of a cycle, you'll see interest rates ratchet up. Now, what's insane, bro, is that during that time where interest rates were 5 to 7% and in the last 3 years being pulled up slightly, we saw Sydney prices go up by 67%. Melbourne prices go up 65%, Brisbane prices go up 102%, and Perth prices go up 120%. Now, rates at that time were like literally 3 to 4% higher than they are today. And once people got their head around rates being a little bit higher, the market continued to perform relative to what we'd expect in the second half of the cycle.
And what we found when looking at those interest rate rises, it was a very gradual increase, even a bumpy up and down over that 7-year period as well. But what we did, we went back to the previous cycle before that one as well and looked at the difference between interest rate rises from 1984 through to 1990 and the property prices in that period of time as well. So run through these ones.
This was that time that everybody's heard from their parents that are around about my age, which was when interest rates were between 12 and 17%. Now, the reason interest rates were so high at the time was because there was also hyperinflation. And one of the things that does extremely well, in fact, probably the best asset class during inflation is property. We are getting above average inflation at the moment, which we historically see during the second half of a cycle. So between 84 and 90, when interest rates were 12 to 17%, we saw prices in Sydney go up 86%, in Melbourne go up 104%, in Brisbane do 75%, and in Perth we saw 81%. So again,
Wow.
what were interest rates between 9 and 15% higher than they are today, or 14% higher than they are today? And that's what I meant at the start of the video when I said it's beautiful to go back and look at the history, because just because the media needs to turn the attention from a boom to a bust because it sells either great or bad, you know, we also need to look back at the history and go, well, what really happened during previous cycles? And I've seen emails recently from Commonwealth Bank talking about similar things, from Ryan from On Property, from the guys over, Tim Lawless at Core Logic, all sort of looking at this in different ways to the way that we did. So if you want to go find out more, just search what those guys have been saying and get a different opinion. But I feel quite comfortable. What I think is going to happen is people, or interest rates will start to rise this year, somewhere between July and November or December. People will freak out for a little while, as they always do, because they won't see this stuff you're seeing now. The market will pause or even go back. People will realize that a 0.5% interest rate actually doesn't change anything when there's $220 billion worth of cash and redraw in the banks, and the Australian average home loan is far, far, far less than the average home loan in the likes of Sydney and Melbourne right now. And so people sit back like they do. It'll be an incredible buying opportunity, or pause for those of you that want to do it. And then we'll be back off to the races, as Phil says, for the last part of the second half of the cycle, where, you know, some people do very well and unfortunately some will get burnt.
So as it's always been, it will likely be a bumpy road up over the next few years. But thank you so much for taking us through that historic data. I think I'll be sleeping a lot easier tonight as well.
Woo!
That's a wrap.
That's a wrap.
Getting
Have a
cool,
spin.
bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
So nice, eh?
Oh.